Welcome to I Know IFRS Educational Fund Series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on international financial reporting standards, IFRS, through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions to which the answers have been provided on IAS 27. This is the standard on separate financial statements. Viewers or subscribers have 30 seconds to select or choose their answer to each question. Please enjoy it. Question number 1. Which of the following holds on that separate financial statements are not presented? A, in addition to consolidated financial statements. B, in addition to an investor's financial statements with investment in a joint venture that is equity method accounted. C, in addition to an investor's financial statements with investment in an associate that is equity method accounted. D, by an investment entity that does not meet the exception to consolidation for all its subsidiaries in line with IFRS 10. E, in addition to an investor's financial statements with investment in an associate accounted for at cost. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 1 is E. That is, separate financial statements are not presented in addition to an investor's financial statements with investment in associate accounted for at cost. All other options of the answers are in line with when or when not separate financial statements are presented. E is the answer to question number 1. Question number 2. The financial statements of a company that does not have a subsidiary, associate, or interest in joint venture may be referred to as dash. A, individual financial statements. B, consolidated financial statements. C, separate financial statements. D, equity accounted financial statements. E, cost accounted financial statements. The time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 2 is A, individual financial statements. Where financial statements of an entity are neither group financial statements nor separate financial statements as provided in IFRS, they are individual financial statements. A is the answer to question number 2. Question number 3. In separate financial statements, investments in joint ventures are carried at all of the following bases except dash. A, cost. B, fair value. C, equity accounted. D, net realizable value. E, B, and C. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 3 is D, net realizable value. In separate financial statements, investments in joint ventures are accounted for at either cost or fair value or equity method accounted. D is the answer to question number 3. Question number 4. Dividends from associates that are equity method accounted in separate financial statements can be treated as dash. A, other income in profit or loss. B, income in other comprehensive income. C, reduction in investment accounts. D, part of revenue. E, income in statement of changes in equity. The time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 4 is C, reduction in investment accounts. In equity method accounting, investment is initially recognized at cost and subsequently adjusted for the post-acquisition change in the investor's share of the investee's net assets. Dividend received on such investment is treated as a reduction or recovery of the investments as cash inflow is recognized. C is the answer to question number 4. Question number 5. Where an entity's right to receive dividend from a joint venture has been established, how can this be treated in a separate financial statement if the investment is accounted for at cost? A, as other income in profit or loss. B, as income in other comprehensive income. C, as reduction investment account. D, as part of revenue. E, as income in statement of changes in equity. The time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 5 is A, as other income in profit or loss. Dividend is recognized in profit or loss from a joint venture when the right to the dividend is established and when the investment in the joint venture is accounted for at cost. A is the answer to question number 5. Question number 6. A company has collected its dividend warrant from its associates, and the company accounts for its investment at fair value. The dividend receivable can be presented in the company's separate financial statement as dash. A, other income in profit or loss. B, income in other comprehensive income. C, income in statement of changes in equity. D, part of revenue. E, reduction in investment accounts. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 6 is A, other income in profit or loss. Apart from where investment in an associate or joint venture is accounted for using the equity method, dividend receivable or received is recognized in profit or loss. A is the answer to question number 6. Question number 7. When a parent becomes an investment entity, the difference between the previous carrying amount of a subsidiary and the subsidiary's fair value at the date of change in status is recognized in dash. A, other comprehensive income. B, retained earnings. C, capital reserve. D, transition reserve. E, profit or loss. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 7 is E, profit or loss. When a parent itself becomes an investment entity, its investment in a subsidiary or subsidiaries becomes accounted for at fair value in line with IFRS 9, and the resultant gain or loss is recognized in profit or loss. E is the answer to question number 7. Question number 8. Which of the following has no nexus with investment accounting in separate financial statements? A, joint venture. B, joint operation. C, subsidiary. D, associate. E, investment entity. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 8 is B, joint operation. While joint operation is an aspect of joint arrangement, as joint venture is, the focus of investment accounting in separate financial statements is on associates, joint ventures, and subsidiaries, whether the subsidiaries are investment entities or not. B is the answer to question number 8. Question number 9. One of the following has no nexus with the core areas of emphasis in separate financial statements. A, IFRS 9. B, IAS 28. C, IAS 2. D, IFRS 10. E, IFRS 11. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 9 is C, IAS 2, which is the standard on inventories. All other IFRS mentioned in the options provide the elements for the scope of separate financial statements emphasis. C is the answer to question number 9. Question number 10. Which of the following is found in the statement of financial position of a parent, but is not found in that of the group's statement of financial position? A, property, plant, and equipment. B, prepayment. C, share options reserve. D, equity instrument investment in a subsidiary. E, cash flow hedge reserve. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 10 is D, equity instrument investment in a subsidiary. Investment in subsidiary, which is found in separate financial statements, is the principal differential element of the statement of financial position required to be eliminated in group statement of financial position. D is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IAS 12 separate financial statements. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of question and answer on standards already covered. Thank you and bye for now.